Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Victoria Gold.
Is gold on the verge of breaking out? This is Paul Harris for Kitco Mining at the Deutsche Goldmesse in Frankfurt in Germany. Joining me to discuss this is Michael Howell, CEO of CrossBorder Capital. Michael, welcome to Kitco.
Thank you.
Before we start talking about the main theme, Michael, let's perhaps just have a summary of CrossBorder Capital. Who are you and what do you do?
Okay, CrossBorder Capital was set up in 1998. It's an investment advisor. We basically produce research, largely for institutional investors, but increasingly high net worth individuals too. We have a money management division as well. That has been primarily focused on fixed income over the past 15 years, but we've actually recently launched a gold currency fund. It was originally a managed account, but it's just gone into an AMC, an active managed certificate, which will be listed on Frankfurt. And that basically looks at 7 major crosses. Gold paper currency is actually delivering pretty excellent returns, I'd have to say.
Okay, well, let's start there with the sort of the macro for gold. What are some of the main trends you think are shaping the gold space at the moment?
Well, I mean, at the outset, let me say that we're very optimistic on gold. So that's a sort of a starting point, a taster. The puzzle in a way is to say, look, the background going into 2024 doesn't look great, does it? I mean, Federal Reserve wants to keep real interest rates high, arguably over 1.5%. Inflation backdrop looks like it's dropping away. I mean, those are the 2 ingredients which should mean the gold market goes down. But there's a lot more going on than that. And I think what you've got to try and understand is the backdrop and why gold goes up. And the fundamental point that we keep making is that gold is not a consumer price hedge, okay? This is what everybody said is, gold is a great hedge against inflation, high street inflation. No, it isn't, okay? It's a hedge against monetary inflation. And that is the crucial difference. And what we're seeing worldwide is a breakout in monetary inflation because central banks have been called upon more and more and more to monetize huge levels of government debt. And this is the problem the world economy has got. There is too much debt. We can't get rid of that debt. Debt is piling up and it needs to be sold. And the only solution out there is for central banks to monetize it away. And that means the gold market's going up. We think gold is in a bull market. In fact, I'd even say controversially, gold's probably been in a bull market ultimately since the late 1990s. That's when the central banks really lost control of things. And that's when they had to start printing money. And you've seen this huge uplift in financial assets and gold really ever since. And it's going to continue.
Do you think central banks can ever get control again?
No. I think the only way they can get control, as evidenced before, if you go back to a period in the early 1990s when the Federal Reserve in particular was targeting the price of gold very clearly, the only way it could get control was by actually tightening and maybe over-tightening and creating a crisis, creating a scarcity of liquidity. The problem was what we ran into then was significant financial crisis, with the evidence being the Asian crisis in the in the mid-1990s, when that was just a shortage of dollars caused the problems there. And from that point on, every time the central banks have tried to step away, in other words, squeeze the market, there's been a financial crisis. They can't do it.
Well, how does this ultimately play out then if the central banks are losing the ability to control and influence the outcome? And how does this ultimately play out?
Well, the end game is probably a lot more monetary inflation. What you're going to see is the empowering of monetary inflation hedges like gold and probably cryptocurrencies. That's where investors have got to start to move. And what we've been in this sort of luxurious situation for the last 10 years or so, or 15 years of actually low inflation. And people really haven't, low high street inflation, people haven't had to sort of confront the problem. Now they're having to confront the problem. I mean, a great example is to look at Japan. In Japan is now veering onto a course of much, much higher inflation. The latest inflation data show in parts of the Japanese price structure are inflating in double-digit rates now. This is unheard of in Japan. And you've got Japanese households sitting on half of their entire financial assets in cash, right? I mean, that is a mad investment strategy for an inflationary environment. It's brilliant if you've got deflation, which they had, but it's madness now.
So they need to adjust. Your firm specializes in monitoring global liquidity flows. At a very basic level, where is the liquidity flowing and why?
Well, I think the first thing to say is what do we really mean by liquidity? What we're not talking about here is sort of conventional money supply definitions. I mean, those sort of they're an archaic definition. They don't mean very much now. Central banks and analysts like to talk about them. They're kind of meaningless unless you believe that the banks, in other words, the high street banks, still have a measure of control, and they don't. The world has moved on, and what we're looking at is the money flow through financial markets. I mean, that includes a lot of wholesale money, repo activity, these sorts of things. And it's that which is really the critical thing we monitor. Now, central banks influence that to a very large extent. One would have to accept that. And so what we're doing is we're monitoring what central banks are doing, what the wholesale financial markets are creating in terms of liquidity, and also looking on top at cross-border flows of money, because those can be particularly important at different times. That money flow moves markets. It moves financial assets, it moves the gold market, etc. And it moves in a cycle. That cycle is roughly something of the order of 5 to 6 years in duration. We're coming out of a trough. That trough bottomed, we think, in October of last year, October of 22. It's rising to a new peak probably around late 2025. It won't be a straight line up, but the fact is investors now have the wind behind them. And what you're looking at in a number of asset classes, and you've just got to look at US technology, look at US cryptocurrency, even look at the gold market. All these things are catching a bid now. They're starting to feel the wind behind them. And economists keep pounding the table and saying, well, look, watch out, there's a recession around the corner. But they've been saying this for, 18 months now? Nothing is happening. The old models don't work. And what you've got to start looking at more and more is what's driving the world, and it's these money flows.
Central banks, particularly in Eastern nations and some of the BRICS, have been building their gold holdings in recent months. Why is this, and what does that enable them to do? And conversely, why aren't Western central banks building their gold holdings?
I think the first thing is if you start to look at maybe non-G7 central banks, so we're looking really here of the emerging economies, the BRICS, etc. They are building gold because they don't really have any alternative unless they want to hold all their reserves in US dollars, which I think in the experience of the last 2 years is not a particularly sensible thing to do if the US can actually enact sanctions. And this is something which would spook a lot of policymakers worldwide. So you've got to find an alternative. And realistically, what is the alternative to the US dollar? One can say, probably the Swiss franc or the Singapore dollar, but these currencies are way, way too small. Nobody can ever put sizable reserves into them. The euro, you're more or less talking about a quasi-dollar, and it will suffer the same slings and arrows as the dollar anyway, so why even bother? And so the only assets you're really left with are physical commodities, or more particularly gold, which is among those the most monetary of commodity assets. So I think that it's inevitable that they're going to start by building up gold holdings, and they are. And I think the interesting point to ponder, which is actually something I'm going to say today, is if you look at the stock of gold held by the BRICS and by the BRIC friends, in other words, those countries that were interested in joining the BRICS forum in the summer, that total now surpasses the total amount of gold, which is 8,000 tons in Fort Knox. So for the first time ever, the BRIC nations are challenging the US as the major gold holder worldwide. So in other words, you could say that the marginal safe asset in the world economy is no longer the paper dollar.
Surely a lot of those factors also bear and weigh on Western nations, the UK, European Union, Switzerland, and others. So why aren't they moving more into gold as well to protect themselves for the same reasons?
Well, I think that's the $64,000 question. I'm not really, I can't answer that. They should be, for sure. And perhaps the reason is, as a sort of mischievous suggestion, they don't want the gold price to go up. The more that the gold price goes up, the more they empower cryptocurrencies like Bitcoin, the weaker their positions are.
Okay. Now, over the summer, a lot of the conversation was about the BRICS and the BRIC wannabes, or those that want to join the BRICS nations and then move away from the US dollar, wanting to trade and exchange in their own currencies, even de-dollarizing. How do you think this movement will play out?
Well, I think inevitably we're looking at a trend here. I mean, is the dollar going to be displaced as the major currency worldwide? No, that's very, very unlikely. The power of the dollar really rests or comes from the power of the US financial system. So if you say to me that the US financial system is going to be eclipsed by another financial system, I'll come quietly and say the dollar is therefore going to be a second currency. It'll be overtaken by another one, the renminbi or whatever it may be. But that is such a fanciful suggestion that any financial system could dominate the US at the moment that it's not even worth discussing. That does not mean to say that other currencies or other types of means of payment will not become empowered. So it may well be that gold or cryptocurrencies become more important, but we're still fundamentally in a dollar system.
Okay, and one of the things that the real trigger of this was the US imposing sanctions against Russia and making the dollar a weapon or weaponizing the US dollar. Do you suspect that the US government will start stepping back from that posture, or is that going to be the ever-present threat that worries other countries?
Well, I think once they've shown their cards, they can't really take them away again. I mean, I think we know that the US in extremis will impose sanctions, and I think if you extend that to other countries like the Eurozone, they will impose sanctions as well. I mean, they are technically. So the reality is that currencies are political. We know that. We know it more now. So you want an apolitical currency, which has got to be gold. And I think that's the reality of why central banks around, let's say outside of the G7, are buying gold more and more.
Now we're approaching the end of the year, coming into 2024. What are some of the things you expect to see next year? What are some things you would like to see next year?
Well, I think in terms of the outlook, I mean, in terms of sort of bigger picture, I mean, number one, the global liquidity cycle, which we look at and worship, is almost definitively going up. And as I say, that's likely to peak in 25. So you've got 2 years of probably decent expansion. The background to that is you will see interest rate cuts from the Federal Reserve. I think one of the issues that the Federal Reserve will face in 24, which is clearly an election year and a very sensitive election year, is there are two major problems cosmetically that has to address. One is that if inflation genuinely does fall significantly, which we believe it will do, certainly by mid-year, and that will be reinforced by the current background of lower oil prices, what you're going to see is US interest rates, Fed funds rates, significantly above the inflation rate, and so real interest rates will look embarrassingly high. And I think that's difficult for the Federal Reserve to argue ahead of an election. So I think they may well have to start to bring real interest rates down in the US, which will mean nominal rate cuts. I think the other thing, which is more technical but equally as important, maybe more important, is the regional banking problem. Silicon Valley Bank went bust last spring. Okay, CSFB also went bust. And the Federal Reserve addressed that by putting more liquidity into the system. What's more, behind the scenes, the Federal Reserve officials almost certainly have gone into regional banks to make sure that they are stable, solid, robust. Okay, this is an ongoing game. The problem is that with an inverted yield curve in the US and with damage already inflicted to the real estate sectors, the regional banks are in have grave problems. And the longer this goes on, in other words, an inverted yield curve and commercial property problems, the more vulnerable regional banks are. Can you have a regional bank blow up in an election year? And I think that's the question. We have, sitting in Washington, the most political Treasury Secretary I can remember for a long time in Janet Yellen, and down the street in the Federal Reserve, Jay Powell is not far behind. So I would suggest that what you're likely to see is some significant policy moves next year to actually add liquidity back into the US financial system, despite the current rhetoric.
One thing we haven't talked about are the conflicts that are underway on the edge of Europe at the moment. Are these a factor or are these just a blip?
You're thinking, I suppose specifically you're thinking about Ukraine, but also extending that into Hamas and Israel. I think that they're clearly realistic problems, but I would imagine that the nearer we get to an election year, or the actual election, the more likely those problems are going to be solved or resolved temporarily at least. So I would think that, it's in everyone's interest to let those things quieten down. I think the more interesting point to ponder about external events outside of the West is what's happening in China. And China has been an interesting economy to study over the last 2 or 3 years, really because China has faced or suffered the problem of very weak currency. The Chinese yuan has collapsed, maybe along with the Japanese yen and the Korean won, but the onus has really been on the Chinese authorities because they've been trying to stabilize the renminbi against the US dollar. Now, that has caused them, for much of the last 2 years, to have a very, very tight monetary policy. That meant that they could not recover out of COVID very quickly. It meant their stock market was damaged substantially. It's never really broken out of its bear trend. Now what they're beginning to do, because they've let the renminbi weaken against the dollar decisively through 7 and probably ultimately will get towards 8, what you will likely see is even more liquidity thrown at the system. The Chinese, since June of this year, have injected 4 trillion renminbi into their money markets, which is about $500 billion US dollars. These are sizable amounts. And what you're seeing is the first signs now of the Chinese economy beginning to get more traction. Viz the iron ore price, a very, very good bellwether, not just of the world economy, but of China, is starting to pick up noticeably.
Okay, now, interesting times. What would you suggest is a healthy investment strategy for people right now?
Well, I think the first question to ask is, what is their investment time horizon? And that's the fundamental question. But let's assume, for the sake of this interview, let's assume a 2-3 year view. And I would say you've got to buy more monetary hedges, okay? The reason I'm saying monetary hedges is that we've got a big, big debt problem out there. And the only way to resolve debt is for central banks to create more liquidity. That is monetary inflation, and monetary inflation tends to push up monetary inflation hedges. The most obvious monetary inflation hedges are gold, precious metals, and Bitcoin.
Excellent. Well, Michael, fascinating stuff. Thank you very much for joining us today.
Great pleasure. Thank you.
And this is Paul Harris for Kitco Mining at Deutsche Goldmesse in Frankfurt in Germany. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Victoria Gold.